Hello and welcome to MC Explains, an investor education initiative brought to you by Invesco Mutual Fund and Money Control. Active or passive? I'm sure this is not the first time you're hearing these words in connection with mutual funds. But today let's understand what these terms mean. Active funds, as the name suggests, are funds which have a fund manager who actively selects securities like stocks and bonds to build a portfolio. Passive funds, on the other hand, do not take active stock selection calls. They are instead constructed to mirror a specific benchmark portfolio. This benchmark can be an existing market index or a customized index built and shared by an index provider to the asset manager to reflect the objectives of the scheme. But which is better? The last few years have seen passive fund assets under management grow at a fast pace, outpacing the growth in active funds, albeit on a lower base. Clearly, this is due to the increasing investor demand seen for this category of funds. The number of schemes in passive funds category has also grown in multiples over the last few years. Moreover, the breadth is expanding too, and a variety of mandates are available to investors to choose from. Since passive funds mirror an index without active stock selection or asset allocation choices being made, the cost of these schemes is significantly lower than that of active funds. There is also practically no difference in passive funds from different asset managers which are benchmarked to the same underlying index. Thanks to this uniformity in portfolios across the same type of passive fund, the choice is easier for an investor. On the other hand, in case of active funds, each scheme, even within the same category, will have a different investment style and portfolio, as it is very much linked with a fund manager and their way of investing. It is not that one is better than the other, but yes, there is a cost advantage in passive funds, and they are also simpler to understand as portfolios are mirrored with the index. Now, how does one decide which to pick? As an investor, you needn't make a this or that choice. It can be either or both. Active funds require more time in selection and review. Since you are going to pay a higher management fee for investing in these schemes, you should take time out to select the schemes with care. The management fee is not charged separately. It is included in the overall annual expense ratio or TER of the fund. Hence, the TER of a passive fund is going to be lower. Now, coming back to the discussion of time to select the active schemes, you need to spend time in choosing schemes, as there are a few hundred available to pick from. Over time, you have to regularly review performance, and in case of unexpected underperformance, review the portfolio fundamentals too. Along with time to pick and review, you need to have some amount of knowledge and awareness around investment processes, styles, security selection criteria of different asset managers and fund managers. When you are choosing an active fund to invest in, the fund manager track record and ability to adhere to the fund objectives, be it in any asset, debt or equity, is paramount. For investors, this is the factor you need to analyze most before choosing one active fund from a basket of many. In case of passive funds, your choice is majorly around the asset itself, and within that the broad index you are looking to invest in. Active funds thus may require the help of an advisor or distributor for you to select schemes that fit into your unique investment plan. The time, effort, knowledge needed to make the relevant choice is not something that each individual investor will possess. In case of certain specific mandates like sector and thematic funds or hybrid funds and many types of debt mutual funds, there may not be enough choice available in the passive basket, in which case you have no other choice but to go the active way. Lastly, for narrow mandates where most scheme portfolios in the category are closely following the underlying index, passive funds may be more reasonable given the lack of differentiation in active funds and the low cost of passive funds. To summarize, passive funds are better suited in case of simple narrow mandates where there are listed indices available as benchmarks. Active funds are better suited in broader mandates where there is enough room for the fund manager to choose individual securities and aim for alpha generation, or in categories where the choices in passives are limited. Passive funds are cost effective, whereas active funds come with an additional management fee. Moreover, active funds need more time and effort for quality selection. Ultimately though, for most portfolios, there is room for both active and passive funds. That's it on this topic. Hope it was helpful. We look forward to seeing you again for the next episode of MC Explains.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.